Hello and welcome to this month's Investor Academy session. This time we're looking at the EIS and SEIS tax breaks. I'm Sarah Turner, for anyone I haven't met before, and I'm joined as usual by Angel Academe co-founder Simon Hopkins, our network manager Michelle, and our partnerships manager Yi-Man. And of course our brilliant speaker and old friend Mark Pattenden, who's the tax partner at haysmacintyre. So as usual, to talk to us this evening, please put your questions in chat. Before we kick off the conversation with Mark, just a little bit about us. So Angel Academe exists to close the gender gap in startup investment. That's both the lack of investment going to female founders, but also the low number of women angel investing. We've been doing this since 2014. We've seen many thousands of pitch decks in that time, and our members have now invested in 49 businesses so far, many of them through multiple rounds. So we have more experience than anyone else in female investment in the UK. Do we still need to talk about gender? Something we ask ourselves all the time. And sadly, yes, we do, especially in the investment space. Most investment is still made by men into other men's businesses. So last year, only 2% of all venture capital funding went to all female founding teams. And angel investment as a whole declined by over 40%. And as female founded businesses tend to be earlier in their growth journeys, they're more dependent on angel funding. So they were especially hard hit. But we've always believed in action, not words. So as I mentioned previously, our angels have invested in 49 deals so far through Angel Academe. We are very close to closing our 50th and the 51st behind it. And that investment has helped mobilize well over 150 million in co-investment. The companies we've backed employ well over 1,000 people in high quality jobs. They generate many millions in revenue, and a lot of them have a social purpose at the heart of their mission, whether that's around diversity, access to better healthcare, sustainability, improved education, and so on. So they're addressing many of the UN's Sustainable Development Goals. We're also very proud to be one of Beauhurst's most active angel networks, and we're the only diversity-focused network on their list. And also proud to be partners with Alumni Ventures and Innovate UK, who invest or deploy funds alongside us in many of our deals. So just how we believe we're different from other networks out there and our offer to both investors and founders. Simon and I are both investors ourselves. Don't invest in all the deals, but we do invest and have invested in a good many of them. And really we started Angel Academe because we wanted to create a network that worked better, where new investors would be supported, but also where experienced investors could benefit from other perspectives, where we could do extremely thorough due diligence, but save time by sharing the work, where founders were respected. After all, their time is precious. They deserve decent sized checks. So our minimum is £10,000. And they do deserve to be asked questions respectfully as well. That's not avoiding challenging questions, but just trying to express things in a positive way. We also wanted to be part of a network that had the resources and expertise to support its portfolio. So supporting the businesses that we invest in after investment is very important to us. And we're very lucky. We've been going for a while now, and our track records creates very high quality and high volume deal flow. We have some great sponsors supporting us and the founders that we invest in with their professional expertise, not least Mark's company, haysmacintyre. Between them, they're giving us and founders advice on deal terms, next stage investment, and of course, tax and accountancy. If your company would like to get more involved, please let me know. But back to today's fun. I'm absolutely delighted to introduce Mark Pattenden again. He speaks regularly at these events for us. He's a tax partner at haysmacintyre. He's been advising us on for 9 years now, Mark, on EIS. So he's one of the leading experts on the subject. I have some questions for him to kick off, and we will kind of cover all the basics of EIS and SEIS, but also talk about what we need to do at this time of year to ensure we get our tax breaks. And there's plenty of time for your questions, so please put them in chat as we go along. Hello, Mark. Lovely to see you. How are you today?
I'm very well, Sarah. How are you?
Yeah, I'm okay. I'm okay, thank you. So let's get cracking. Very quickly, what is SEIS and EIS?
Well, EIS, the Enterprise Investment Scheme, and its younger sibling, the Seed Enterprise Investment Scheme, SEIS, are two tax incentive schemes that have been introduced by the government to encourage people to participate in angel investing. It's to widen the net and to encourage people to, with tax incentives, to invest in small stage and early startup businesses.
And I've got some statistics to back that up. So it absolutely drives angel investment in the UK. So 85% of UK angel investors use it. By May last year, nearly £30 billion had been invested into more than 53,000 businesses since the schemes were created. And nearly 5,000 companies raised a total of 2.3 billion in the 22 to 23 financial year. So it really is massive and hugely valuable. So just starting with founders, what is it that they need to do to get ready to fundraise from angel investors?
Well, EIS and SEIS are both founder and entrepreneur-led incentive schemes. So it's the founder's responsibility, the company's responsibility to check that it qualifies for EIS or SEIS eligibility prior to going out and fundraising. Because if you're fundraising on the basis of your investors getting tax relief, then you need to provide them with some reassurance that if they invest in your company, then they will actually qualify for that relief.
So yeah, and just to kind of follow up, clarify on that, if it's their very first fundraise and they haven't got advanced assurance, they need to establish some initial interest and apply this thing called advanced assurance.
That's right. Let's talk about advanced assurance. It's the process by which a company applies in advance of fundraising to HMRC, provides them with a whole series of information, and it can get quite complex. So you'd send them business plans, you'd send them financial forecasts, you'd send them details of what your company is, what it does, what it will do, and particularly what it will do with the money that it raises. So it has to demonstrate that it's going to be using the money to enhance the business, to grow the business, not merely to pay off its existing debts. One of the things that has been recently introduced by HMRC is this requirement for indications of interest. That when a company makes an application for advanced assurance, it has to demonstrate that people are actually interested in making an investment. Previously, HMRC estimated that about 30% of all applications for EIS approval and for advanced assurance were actually speculative. So it was wasting almost a third of its time on applications that didn't actually progress to investment. So what they've said is that when you make an application for advanced assurance, and basically what they'll do is HMRC reviews the plan and says, yes, you're a qualifying company. If you do what you say you will do, your investors will qualify. What they're looking for is a handful of people, doesn't have to be that many, just a handful of people who have already expressed an interest in investing in the company.
Okay, so this doesn't need to be committed money, does it? It just needs to be a list of helpful individuals who are looking seriously at the business and potentially might invest, subject to SEIS or EIS pre-assurance.
That's absolutely right. There's no commitment. These people don't have to ultimately be investors, and just because your name wasn't on the initial list doesn't mean to say that you can't be an investor in the future either. So it's not an exclusive list. It's just demonstrating that there is actually interest in investment in the in that company.
And then if you have raised investment before, so you've had advanced assurance previously, you can get that renewed, can't you? But you don't need to supply as much information, presumably.
That's right. I mean, looking at it from the investor's point of view, we looked at it from the founder's point of view as advanced assurance is a good thing to have because it's part of your marketing effectively to your investors. Looking at it from the investor's point of view, the advanced assurance is only as good as the date that it was issued. And if you're looking at investing in perhaps the second round of fundraising or even subsequent round, your investment is determined by what the company is now, not what it was when it originally got its first advanced assurance. So you might be thinking that actually, should the company be reapplying? And then has it? Am I satisfied that the advanced assurance that the company provides me with, and you can ask as an investor, you can ask for a copy of their advanced assurance from HMRC. Is that advanced assurance still valid? Are they still doing what they said they were going to do originally? Has the company pivoted into something else that may or may not be qualifying?
Sorry about my coughing. That's something typical. So at Angel Academe, we only invest in SEIS and EIS qualifying companies, but not every company does qualify. So what are some of the reasons a business might not qualify?
There are different types of category. I mean, there are trades that do not qualify. So things like professional services, property development, regulated banking and finance are all areas where the company the company would not qualify because it's not a qualifying trade. But generally, everything else would do. I know you've invested in some financial services, what would appear to be financial services companies, but what they're actually doing is providing software as a service, and software is a qualifying activity, even if that software is related to banking or financial services.
There is the distinction that it's unregulated financial services do tend to qualify.
They can. It's certainly something that you'd need to be very careful about. And again, the advanced assurance process would enable you to demonstrate to HMRC and ultimately demonstrate to your investors that you're a qualifying company.
So we've backed quite a few fintechs, and none of them have been turned down. Yeah. So and when they go back and reapply for the following fundraise, they've always been eligible as well. So
yeah.
Okay. So moving on, we've established that a company is eligible, amongst other things, in due diligence, and we've made our investment. What's then the process for claiming tax relief, both for companies and investors?
This is where it really does become a founder-led process, because it's the company's responsibility to submit the EIS application to HMRC. So once it's received the funding, once it's closed the round, issued the shares, it then reports everything to HMRC, submits all the details of the investors, how much they've invested, what so on and so forth. And then at some point after that, depending on how quickly HMRC processes it all, HMRC will authorize the company to issue to its shareholders what's known as an EIS 3. And it's that certificate that enables you to claim the tax relief. Because it's that certificate that certifies that the investment was qualifying.
Right. Okay. And it can take a while, can't it, for the EIS 3 certificates to come through. Sometimes founders are doing what we call rolling round. So there'll be various kind of dates, and they might wait for the full round to close before doing the EIS application, just to make admin a bit more straightforward.
Yeah, that's right. I mean,
and then I was going to say you were a bit at the mercy of HMRC and how busy they are at that current moment as well. So
yes,
what we always say to founders is just communicate with your investors about where you are in the process and what's happening. So
I think that's absolutely right. It's the communication that's the key. This is the stage where it does get frustrating because investors have put their money in. They're looking for tax, looking for the confirmation of their tax relief, looking for their EIS 3 certificates. Depending on what stage of the year they're at, they might be looking at making a tax claim for the tax relief on their investment, which I'm sure we'll come on to in a bit. Yeah, it's the communication is the key, because quite often it's the founder has done everything that they can. It's with HMRC. Unfortunately, we're at their mercy for how long it takes, but there's nothing more that the founder can do. But unless they communicate that to the investors, we can sometimes get an issue with just the lack of communication can be frustrating.
Yeah. So I think, yes, just be clear about that you've submitted your bit and it's just in HMRC's hands now. So okay, and then moving back to investors, when is it that they can make their claim?
So once they have received the EIS 3 certificate from HMRC, that's the point at which an investor can make a claim. Now they can do that by putting it on their tax return for the year that it was invested. The key date of investment is the date that the shares are issued, not the date that you wrote the check or sent the bank transfer to the company. It's when the shares were issued. So that crystallizes the year of your investment. You can either claim tax relief for that current year, or you can carry it back and claim tax relief in the previous year. Now, there's a form attached to the EIS 3, which enables you to fill it in and send it off to your tax office and to claim if you want to carry it back to the previous year. Otherwise, you hold on to it, you give it to your friendly accountant who's doing your tax return, and they'll put it on your tax return in the year of the investment.
Okay, and I think that's a really kind of important point, isn't it, about the carry back year? So you can carry back 1 year.
Yeah.
If you haven't used up all your EIS allowance for the previous year, but you can't carry forward, can you? It's only a 1 year carry back.
That's absolutely right. So if I'm making an investment today, I could claim that against my 23-24 tax, because that's the year of the investment, if the shares are issued prior to 5th of April. Or I can carry it back and set it against my 22-23 liability. And that might depend on the individual. It's an individual investor choice. So once you're at the tax relief stage, it's down to each person, each investor, to make their own decision about how they want to apply it. So, for example, if I'd stopped working in the current year, whether that's retirement or career choice or whatever, and I don't have an income in this year, but I did last year when I was working, I could carry my investments back to 22-23 and claim the tax relief against potentially my PAYE income in the previous year.
Excellent. Okay. So moving on to actually some of the reliefs, and starting with the downside protection, because sadly, a lot of the businesses that we invest in won't be successful, however much due diligence we do and however great they are. So what percentage of your investment is actually at risk when you make an EIS or SEIS qualifying investment?
Approximately just over a quarter of your, if you're claiming under SEIS, and I guess we ought to talk about what the actual difference is between EIS and SEIS as far as tax relief is concerned. SEIS is very young companies, so within 3 years of startup, and because they are perceived to be higher risk, you get a higher rate of investment return. So you are eligible for 50% tax relief on your investment. So put in 10,000, get a £5,000 tax rebate. EIS, much more established businesses generally. Therefore, the tax relief is 30%. So put in £10,000, get £3,000 back. Now, immediately, you've de-risked your investments by 50% and 30%. There are loss reliefs available if the companies go bad. Depending on which rate of tax you are, what your marginal rate of income tax is, you can claim those capital losses, which effectively they are, against income tax instead. So instead of getting 20% capital gains tax relief, you could get up to 45% income tax relief if you're an additional rate taxpayer. Now, ultimately, that means that your risk is down to about just over a quarter of under SEIS, and just under 40% of EIS. So for a £10,000 investment, you could get over £6,000 back in tax relief for EIS, and effectively less than 40% of capital is at risk.
Okay, and then if things do go wrong, we'll cover the downside first and then move on to the upside. If things do go wrong, the company you've invested in fails, what's the process for claiming loss relief?
It depends on what you mean by fails. So a company, if it goes into administration, doesn't fail because you haven't lost your investment. It's become worthless, and we'll come on to that perhaps. But merely the process of going into administration doesn't mean that you crystallized a loss. The appointment of a liquidator does, because the liquidator takes all the assets, takes ownership of the company. That's a crystallizing event, and effectively you've lost your money at that stage. The process of administration is slightly different. It might be that effectively you've lost everything because somebody comes in, the creditors are converted into equity shareholders and you're diluted down to nothing, for example. Then you might want to make what's known as a negligible value claim. And that basically means that you are declaring that your shareholding has become worthless. You haven't crystallized your loss, but you're stating that the company has become worthless. And it basically resets your base value to zero. If subsequently you get an investment return back from it, your capital gain will be taxable. But it does enable you to crystallize a loss at the point when the company becomes worthless in your hands.
Okay, and is that the same, the negligible value claim, you'll get the same loss relief as if it went into liquidation and
Absolutely. So yeah, it's the same process. It's the same outcome, slightly different process. You put a claim on your tax return saying that the company's become of negligible value. I have lost X. Because it was an EIS investment, I can convert that capital loss into an income loss, and it's the same process as if the company had gone into liquidation.
And then the other scenario is if a company you own shares in sells for less than you paid for it, can you then claim loss relief?
Yes, you can still claim loss relief. The issue is if you dispose of your shareholding within 3 years, you may be required to repay the income tax relief that you had. on the original investment. But yes, you still can get loss relief on the capital loss that you've incurred if you sell it for less than you paid for it.
Okay, all right. So moving on to the upside now. Obviously, we hope that in our portfolio of angel investments, some will sell for far more than we paid for them. What are the upside advantages we get from EIS?
We've already talked about the income tax reliefs. So as I said, 50% investment return or tax relief return on your investment for an SEIS investment, 30% for income tax relief for EIS. What you also get is a capital gains tax exemption. If you hold the shares for more than 3 years and then you have a successful exit, so you're selling out at multiple times your investment, providing the company didn't cease to qualify, and as I say, providing you've held the shares for more than 3 years, then effectively, or actually, your capital gain will be tax-free on exit. There are also a couple of other opportunities. There's what's known as capital gains tax deferral, which allows you to defer the capital gains that you incur on other assets by investing into EIS and SEIS qualifying companies. So, for example, if you had a sale of a buy-to-let property that generated a capital gain, and you took the proceeds and you invested into SEIS and EIS companies, then you could potentially either exempt some of that capital gain entirely or defer it into the future until you sell the capital gains tax, the EIS qualifying shares. Final tax advantage, one that's often overlooked but sometimes relevant. Once you've held the EIS and SEIS shares for 2 years, they become exempt as far as inheritance tax is concerned.
Okay. Excellent. So another advantage, something that I've been kind of thinking about recently.
Far too well, you're far too early to think about that, Sarah. But I do have clients who have invested in EIS and SEIS portfolios as part of it's an inheritance tax planning process. 2 years, they invest in the companies. If they've got high income, they can get tax relief on pension income because you can offset it against any type of tax liability. And then those investments are exempt for EIS and for inheritance tax after 2 years.
Excellent. So if anyone's thinking along those lines, there you are, you heard it here first. So quite often when I'm just thinking about a deal we're working on at the moment, raising, £500,000, £750,000, the first £250,000 of that is SEIS eligible and the rest is going to be under EIS. How does that work with investors? How do you allocate it?
It's also almost a matter of negotiation. They're effectively running 2 rounds, an SEIS qualifying round and an EIS qualifying round. The SEIS qualifying round must close first, but that could only just be a day before the EIS round closes. How they allocate it is entirely down to your negotiating skills and their choices. It could be on a first come, first serve. That might be deemed to be fairer, or it might be on a pro rata basis so that everybody gets a share of EIS and SEIS benefits. There's no real, or there are no rules to say you have to do it this way or that way. Only that the SEIS qualifying round must close first.
Okay, all right. I'm conscious that we've talked through quite a lot of detail, but you have a great slide that outlines the main reliefs on one page. Do you want to bring that up and just kind of pull out the highlights just to remind people?
Certainly. effectively, this is a demonstration of the by numbers for those of you that learn visually rather than through speech. Again, an example of a £10,000 investment under SEIS or EIS. Your income tax relief is 50% or 30%. So immediately a £5,000 or a £3,000 tax refund. If the investment went bad, then you get tax relief at your marginal rate on the remaining value of your investment, tax value of your investment. So that's the value after your tax relief. So for an SEIS investment, you're getting 45% tax relief on a £5,000 investment. And for EIS, you're getting 45% tax relief on a £7,000 investment, because that's 10,000 minus the 3 that you've already had. So as you can see, the total tax relief that you could get for SEIS is, for a £10,000 investment, is £7,250, which basically means that you've put at risk 27.5% of your investment. And for EIS, the total tax relief possible is 6,150. So you're risking 38.5% of your investment. There's no there's no investment opportunity that could be de-risked any further than this. This is the most tax efficient investment that you could possibly make. Now, the key obviously isn't just to look for the most tax efficient investment, as Sarah will I'm sure confirm. The whole due diligence process is much more important to make sure you get the right investment. But by doing it under EIS and SEIS, you get the best of both worlds.
Yes, we should be investing in great businesses and taking advantage of the tax reliefs at the same time, not the other way around. So yes, thank you for making up that point. So my last question is, we're coming up to the end of the financial year. Do you have a short, hopefully short list of things that we should be doing housekeeping wise to make sure that we're maximizing our benefits?
Well, absolutely. I mean, the most important thing is to make sure that you have an income tax liability to offset against your investments that you make. So we talked there about a £10,000 investment giving you a £3,000 tax refund. You can only get refunded the amount of tax that you've paid. So making sure that the potential refund that you're going to claim through EIS, you've actually paid that amount of tax in the first place. Now, as I said, we have the opportunity of carryback, so that if you don't have a tax liability in this year, you could carry it back to last year and offset it against last year's tax liabilities. That is dependent on the date of closure of your EIS or SEIS investment. So as we're getting quite close towards the end of the tax year, if you're starting to look at a company investment now, you need to make sure that the round closes, and you want to carry it back to last year, you'd need to make sure that the round closes before the 5th of April. And you'd need to make sure your founder is aware of that. Otherwise, you could end up...
The date on the shares, isn't it? The date.
Absolutely. It's the date of the shares that the shares are issued, not the date that you transfer the money to them.
We do, you know, if it's around this time of year, we spend quite a lot of time with founders and with investors. Sometimes we have some people getting their shares after the end of the financial year if they want it in the next year. But yes, yeah. So just so everyone's clear on that and they get what they want. So again, back to good communication.
Absolutely. And the other overriding thing I would say is don't scrimp on the DD. Make sure you carry out full due diligence. Don't go chasing the tax liabilities, the tax reliefs at the expense of a full investigation and making sure that you are happy with the company, because it's not that the tax relief is fine. You could get 61% of your investment back, but if it was a bad investment, you shouldn't have been putting the money in the first place.
Yeah, and you know, cash flow and your time is
exactly.
So yes, so not letting the tail wag the dog. So we have a couple of questions coming in. The first one's from Laura, and she has said that is there any way to put in the tax claim without the certificate? So your EIS 3 certificate? Because
no.
But you don't send the certificate to HMRC, do you? So
you don't send the certificate to HMRC, but the certificate does now disclose what's known as a unique investor reference number. And you are supposed to disclose that reference number when you are making your tax claim, whether that's either through a form or through the certificate. You don't physically, you need the certificate needs to have been issued to you, because until you actually get the certificate, there is no guarantee that your investment actually qualifies, and HMRC has not certified that your investment has qualified. So you might have gone through the process. The company might have claimed its or got its advanced assurance. You've put your money in. The company's issued the shares to you. It's put in its EIS claim. And then the company does something wrong, for example, or it ceases to qualify. At that point, HMRC will refuse to issue the certificate. If you haven't got the certificate, you can't claim the tax relief. And if you claim the tax relief, HMRC will open an inquiry into you, and you don't want that.
Okay, so sorry, Laura. No, please just hang on until you've got your EIS 3 certificate. We've had a question from John. If I don't claim income tax relief, can I still get CGT relief?
You can't get CGT exemption on the disposal if you haven't claimed income tax on the way in. So you do need to have claimed income tax relief in order for the gain to be treated as CGT exempt. You can still qualify for CGT deferral on other assets, but that's a separate matter. If you want your shares to be tax exempt when you exit for multiple times your investment, you have to have claimed income tax relief at the beginning.
Okay, and this has come up in a previous discussion, isn't it? It doesn't have to be income tax relief on 100% of the investment to qualify. It's even a tiny bit of income tax relief will
a tiny bit will count, providing the reason that you didn't claim it all is that you hadn't got enough income. You can't just claim £1 worth of your investment and not claim the rest of it. You do need to effectively wipe out your income tax liability. Can be a little bit complicated. The best thing to do is to make sure that you've got sufficient tax liability to cover your full investment.
Okay, all right, thank you. I hope that answers your question, John. Put another one in chat if it doesn't. So question now from Rowena. I failed to declare EIS losses that crystallised on a sale of assets in the 2015 to 16 tax year. Is there anything I can do, or have I missed the opportunity? Shares were purchased in 2010.
I'm afraid you missed the opportunity, Rowena. You have to claim a capital loss within 4 years of the loss crystallising in order for it to be valid for tax purposes. So your 2015-16 loss would have had to have been claimed by 2020 in order for it to be eligible. Unfortunately, it's no longer eligible.
Okay. So don't hang around on these things. So Laura has got another question for us. Is it just the tax rebate that you need to have paid in tax? So for example, a 10,000 EIS and you get 3K back, you need to have paid 10K or 3K. No, I can.
You need. I was going to say you need to have a tax liability of £3,000. So I'm not going to attempt to do the back of the fag packet calculation of how much income you need to have a £3,000 tax liability, because you've got things like personal allowance and various other issues that you need to take into account. But it's you have to have a tax liability of equal to the amount of tax you want to reclaim via EIS.
And Aurélie has said, can we go back over the scenario where there is a successful exit and the capital gains are tax-free on exit? So
I think you've just summarised it actually there, Aurélie.
As long as you claim the relief.
If you've claimed the relief originally, so you've invested in a company, the company has issued you with an EIS 3 certificate. You've claimed the income tax relief attributable to that EIS investment. You've got your tax refund. Thank you very much, HMRC. If you've held the shares for 3 years from the date that the shares were issued to you, 3 years after that, as soon as the company exits, you will get a capital gains tax-free exit.
Okay, excellent. So no CGT. Fantastic. So we have a good question from Louise, who's a founder and planning an SEIS round. And she's saying, how do angel investors feel about being approached to be named on the advanced assurance application? Perhaps I can answer that one as somebody who manages an angel network. I think, build a bit of relationship with them first. So it shouldn't be the first question you ask of them, but if you're speaking to angel investors, they will obviously be keen to get the SEIS, so it's in their interest to support your application. So once you know them, you think there's a bit of interest, you just ask. And if they're experienced investors, they know the routine. So yeah, go to people who've done this before. I think that would be the easiest conversation. So a message from John Bugger, who said he was asking about the CGT relief if he hadn't claimed EIS. Can you restate a previous income tax return to include the EIS relief?
You have up to almost 5 years in which to claim income tax relief on an EIS investment. So you don't necessarily need to restate a tax return. What you can do is, if you've had an investment in a couple of years ago, providing it's still within the 5-year time limit, you can just write to HMRC, probably send them a copy of the EIS 3 certificate, and claim the tax relief, just as a standalone claim outside your tax return. So yeah, all is not lost, providing it's still within that 5-year period. And effectively, they will give you the tax relief for the year in which the investment was made, as if you had put it on your tax return originally. Okay.
So there's a question about a change in government, and would that be likely to lead to changes? And I mean, I don't think so. These are tax reliefs that have survived and been expanded through both Conservative and Labour governments. So
absolutely, these were originally, if we go back to its original form, these were introduced in the 1980s. So as you say, EIS as in its current form was introduced in the 1990s, SEIS much more recently, but the investment, the provision of capital to small businesses that EIS and SEIS encourage is too valuable to the Treasury, to government, to the Department for Business, because if they cut off this access to capital, they'd have to replace it with something else, and that something else might end up being state aid. So it's much better to give private individuals the the investment to support these companies than it would be for the government to pay for it themselves. So I can't see, there may be some tinkering around the edges. There may be some reductions in tax relief. Maybe 50% is too generous. EIS originally was 20%. It was increased to 30%. It may come down. It may come down again. The annual allowance effectively for EIS is £1 million. So if you are lucky enough to be able to have a mega income and mega earnings, you could put £1 million into EIS. Is that necessary to have it at £1 million? Yeah, if they reduced it, probably half a dozen people would be affected. But yeah, there are things that an incoming government could tinker around the edges with, but I don't see any substantial changes to the system.
It was only a year ago that they increased the SEIS limit from 150 to 250. So the direction of travel has been more generous rather than less, I think. So.
Yeah.
So a question that comes up quite often, because it's not entirely straightforward, is what involvement can you have with the company and remain eligible for either SEIS or EIS?
Well, there's a shareholding limit, first of all, that you can't own more than 30% of the shares and be eligible for EIS. But I think the question that you're really asking is, if you are an angel investor and invest in a company, what involvement can you have after your investment? And you're eligible to become a director of the company if you wish. You shouldn't be a director or an employee prior to your shareholding, but afterwards you can become a director. You could become a board advisor, a non-exec director, whichever you want to describe it as, and you can be paid for that role of providing advisory services to the company, providing the amount that you're paid is commensurate with the services that you're providing, and it's not a disguised way of giving you back your investment, then those are absolutely fine to become effectively an advisor and a paid advisor to the company after you've received your shares.
Okay, and then there are some limits to the duration of EIS eligibility for businesses. So how long do you remain EIS eligible?
Certainly. So you have to be, in order to make your first investment for an SEIS company, you have to be less than 3 years old. And for an EIS company, it has to be less than 7 years from your first sale. So those are, these are demonstrating that these investment opportunities and the eligibility of the companies is designed for small, early stage businesses.
Okay. There is an extension for knowledge intensive companies, isn't there? We've seen some people have their EIS.
There is. So for knowledge intensive companies, which are companies that invest heavily in R&D, then EIS is available for the first 10 years. But again, it's down to the company to assure itself and to obtain assurance from HMRC that at each stage of the process, every time it's doing a fundraising, that it wants to qualify. It's just to refresh its advanced assurance to provide that reassurance to its investors.
Okay, so probably my last question applies to this. Is something that comes up quite often. Do tax reliefs apply to dividends as well, or only to exits?
It's only to exits. You get tax relief on the way in and tax exemption on the way out. Dividends are not covered by any tax exemptions. So if an EIS company pays a dividend, it is taxable in the same way as a dividend from a FTSE 100 company. Most EIS companies wouldn't pay a dividend because, from an investor's point of view, you want that money put back into the business. You want the value of the business to grow tax-free. You're not looking for an income stream. If you're looking for an income stream from a capital venture, then things like VCTs, venture capital trusts, might be the way to invest rather than EIS. What you're looking for is put the money in, grow the money, sell the business, and get your tax-free exit that way.
So it's very important that founders are aligned with that thinking. So we're aiming to invest in businesses that have an ambition to exit, not a million years in advance, but exit and give us a decent return, and then we can really get the benefit of the tax reliefs.
Yeah, you don't want the investors. You certainly don't want the founders to become comfortable with an income stream, and regularly paying out dividends. Now, that might be what some investors want. Again, you're not really looking for those companies. Shouldn't be looking for EIS investment, because angel investors don't have that mindset.
Okay, thank you very much, Mark. That's extremely helpful. How can people get in touch with you?
I'm available on email, by telephone, and on LinkedIn. There, my email is now in the chat.
Thank you, Michelle, right on cue.
If you will bear with me, I will just
in touch
share
with Mark. He spends a lot of time advising both founders on their EIS advanced applications, but also us investors on how we can maximize not just EIS tax reliefs, but all the tax reliefs across the board.
There you go. I will.
So thank you, Mark, for your valuable time and insights. It's been really helpful. Simon, if you could bring our slides back up. I am just going to keep everyone on the line for a couple more minutes just to talk about next steps. So, yes, if you're a founder looking to raise money, please apply to pitch to us via the website. It's a short application form. We read absolutely everything, and somebody will be in touch soon about next steps. If you're an angel investor and not already a member of Angel Academy, please feel free to reach out to Michelle, and then we'll join you up for our regular pitch events. And you can follow us on various social media, so LinkedIn, and our newsletters on Substack, and recordings of other webinars like this are on our YouTube channel, and you'll find a recording of this in the next couple of days. And then coming up, next month's webinar, we're going to be looking at IP and regulation. So what angel investors and founders need to know. So that's going to be a session with Kingsley Napoli, who are our legal partners. And in April, it's our partners at Alumni Ventures giving a perspective of what they see happening in the US. So hope we'll see some of you at those events. But thank you all for joining us this evening. I hope you found it useful. Please do reach out to Mark. Please do apply to pitch to us or to join us, and hope you have a lovely evening, and see you again soon. Bye.
Thanks very much, Sarah. Thanks, everyone.
Thank you, Mark.